Hi, my name is Jason Ani.
Hi, my name is Manish Sanani, and we are here to basically kick off a TikTok channel. This is our first attempt to kind of show the world how and what we are doing on a daily basis to own amazing stocks, and while owning those stocks, being able to rent those stocks out week after week and collect income on them. We call this strategy the Aloha Alpha Bets strategy. We are kicking off this TikTok channel. What you see Jay sitting right here. He is a 16-year-old high school student going to Lake Washington. He's himself very interested in financial markets and hedge funds and trading. And so we are kicking off this channel as a father-son exercise for me to teach him and everybody else what we are doing in the markets today. We have been generating significant income month over month, week over week over the last few years using this strategy, and it has been working really well. So this will be a channel where we'll be discussing our strategies on a daily basis. We'll talk about the stocks. We'll talk about the stock market. We'll talk about what has happened on that particular day in the market, how we made money or we lost money if we did that. But in general, this is not a channel to talk about day trading. We do not day trade. We do not necessarily, I would say, gamble in the stock market. What we do primarily is we use stocks and we use options to collect income on our stocks that we own, or we use options to purchase stocks that we don't own. Yeah, that's basically it in a nutshell. I will open this up to the first question for Jay, for him to ask me a question, and we'll kick the series off as Jay asking me questions, me trying to answer those questions, and make this conversation interactive with all of you. We will also plan on doing live sessions during the market. Jay goes to high school, so it'll be hard for him to get on the channel on a live channel during school hours, which is mostly during 6:30 to 1 p.m. Pacific time. So maybe once in a while before Jay goes to school, we'll do a morning session on TikTok to talk about what we have done on the market that day. But with that said, let's go ahead and get started. Jay, what's your first question for me?
So what is like the basis of your strategy? How does it work?
Yeah, so that's a good question. If you think about our strategy, basically what we do in our strategy is we purchase, stocks that are really focused on generating significant amounts of free cash flow. So the first most important thing that in our strategy that we focus on is we only look at buying businesses that have really good free cash flow. We call them strong FCF. So that's the first thing. After we purchase a stock that we really like.
What are some examples of these stocks?
What are some examples of these stocks? Yeah, that's actually great. So some great examples of these stocks are stocks like Apple, Google, Microsoft, Meta. Berkshire is my favorite in terms of generating free cash flow and then giving that cash flow back to shareholders and investors. So our most important part of the strategy is we don't gamble with companies that don't make money.
Right.
And we don't invest in companies that don't make money, but we don't even gamble with companies that don't make money. So our most important thing is let us focus on companies with strong free cash flows and strong moats, economic moats. Moats that are, what we mean by economic moats are businesses that are going to sustain themselves no matter what happens to humanity.
What's a moat?
A moat is basically the ability of a business to continue selling and having economic power because they are ingrained in a society. So as an example, Google today has a moat on search. Google is a search engine. Everybody uses search and Google interjectively. Another example of a moat is Uber. Uber has the moat on a ride-hailing app. So it's the most popular ride-hailing company. Another example of a moat is Apple. Apple has a moat in phones and in computing systems. Another example of a moat is Meta. Meta has got a moat in social networks. So these are businesses that have significant economic power. They make a lot of money, and they also influence government. They influence economic policies. Then we have companies like Procter and Gamble and Johnson and Johnson and Merck and other large companies like Berkshire Hathaway that also have significant moats in the insurance business or in the healthcare business.
Okay.
Right? So we talked about the original question was, what is our strategy?
Yeah.
Right? So we talked about the first most important part of our strategy being
which stocks you invest.
Which stocks you invest. Then we need to figure out in our strategy to make sure that whatever we buy, whatever we have invested in, we want to make sure it's a good investment, but it is also paying us income on a weekly, monthly, and an annual basis. Mm-hmm. So what we do in very simple English with stocks is we purchase the stock and then we rent these stocks out.
How do you rent it?
And we'll talk about how we rent it. We rent these stocks out on a weekly basis at a price above which we are willing to basically sell at. Okay, and if that price of that stock doesn't hit the price we rent it out at, we get to keep the stock and collect the rent every week. So in the options, we basically use a system called options. Options is a derivative. It's a derivative product, and we'll spend a lot of time on options and talk about options in a later episode. But in the most simple words, what we do is we purchase a stock, and then as soon as we purchase the stock, we sell a covered call option against that stock. And usually you can only do options with a minimum of 100 stocks. So this strategy only works if you have at least 100 stocks of some stock, and that same stock should have options that are traded. And usually we focus, like we said, on only the largest companies that have great free cash flow. So companies like Apple, Berkshire, Meta, Google, etc. These companies usually have a very, very healthy options volume. And what we do is week over week, we sell covered calls against our options positions. Because we are obviously sophisticated investors, and we usually have more than 100 stocks of a stock, what we do is, we do some interesting, strategies called sell the wall. And we'll talk about sell the wall a little bit, which basically lets you sell the entire volatility wall. So if a stock is trading at $100, we collect income both below the $100 price as well as above the $100 price. So if the stock moves during the week, we collect income on the volatility of the movement of the stock.
So basically, no matter if it goes up or down.
Yeah, exactly. So no matter whether the stock goes up or down during the week, we get to basically make income. And we make income in this way because we focus on basically, making money when volatility happens and when the time decay happens. So those are the two other portions of our strategy. Since today is our first call and it's our first video, this is definitely not something we scripted. Being very transparent over here, we have zero script. Neither Jay or I have written down and done any scripting here. He has asked me questions and I'm answering those questions on the go. We'll definitely talk a little bit about sell the wall, which is a big part of our strategy. We'll talk about that and we'll tell you how we put that into action. We'll also talk about strategy 69. It's a fun thing. I like the 69 number for a variety of reasons, but 69 is a great number because we look at that as a threshold at which we start taking profits. So we measure probability of which options will expire worthless. So if they have a 69% chance of expiring worthless by the end of the week, we try to sell those options. So we look at options volatility and probability of them expiring worthless, or a probability of our trade becoming successful. And only for options that have a 69% or greater probability of expiring worthless, those are the options we end up selling and collecting that income for the week. We'll also talk a little bit about sell the wall in more detail in our next call. But with this, I want to have one last question for Jay before we close this call up, since we are hitting that 10-minute mark.
So what happens if the stock doesn't have much volatility?
So that's a good question. If the stock doesn't have much volatility, what happens is we end up, selling calls closer to the purchase price, not further away. If a stock like Tesla, which moves a lot, it allows us to sell, calls 5, maybe 7, 10% out of the money. Whereas if you look at stocks like Procter & Gamble or Johnson & Johnson or Berkshire that don't fluctuate a lot or are not as volatile, they have a low beta. So in the stock market, beta determines how volatile your stock is. So if the beta for the stock is low, that means it's not very volatile, then we sell covered calls closer to the money. So if the stock is trading at $100 and it is not a very volatile stock, we will sell the $101, $102, and $103 call because the stock may only fluctuate 1, 2, or 3% a week. Whereas if a stock is volatile and it fluctuates 5%, we could sell $105, $110, and $115 calls. So you adjust the amount of rent you can collect every week based on how volatile the stock is. Our goal as an investment, from an investment standpoint, we have a goal to make sure our first most important rule is don't lose the capital you invest. Rule number 1, as Warren Buffett says, is, and Charlie Morgan says, is your rule number 1 as an investment is do not lose your initial investment. And your rule number 2 is to remember rule number 1. And that's where we close things out. Thank you.
Thank you.